it's a pause. You can almost feel the people holding their breath right now, waiting for this jobs report. Now, tell me something. Depending on what sort of read we get, what are your various scenarios?
Look, I think, even if we get a higher than expected non-farm payroll number today, I mean, we look at broad indicators of the U.S. economy, and we do see some, of the labor market indicators are actually starting to ease already. And in addition to that, inflation expectations are also starting to come off. So, it does point to the fact that, when you look under the covers, there is a little bit of that slowing U.S. economic momentum coming up. And I think that's going to play into the dollar view, into the yield review, into year end and early next year. But will take some time.
Okay, take some time. I'm just wondering, what is it going to take to drag it lower, for one thing? There's a lot of talk about Japan, whether they actually intervened or not this week in the currency. Are we likely to see more of this sort of thing? And what sort of impact could it have compared to what we saw last year?
Look, I think with what happened with Japan and dollar yen this week clearly points out the fact that whether it was checking rates or whether it was intervention, either way, we know 150 is really drawing the line in the sand. Now, of course, it was driven by the fact that yields had continued to establish new highs this week. Now, if this continues to remain elevated and sustainably higher over the next couple of weeks, surely we will test that 150 and above mark, and we will see some intervention coming in the near term. Okay,
so with the sort of mood music right around surrounding the dollar, all the stars seem to be aligned for it to continue to have strength going perhaps even into the end of this quarter. But what could actually be a spanner in the works for the currency?
Look, I think for the dollar, a couple of key drivers could take it a little bit lower. Of course, we already saw the PMI services in the U.S. starting to trickle downwards. We look at the NAHB housing market index, that's also trending lower. Not forgetting the excess savings in the U.S. will soon be running out. And obviously, we got the, United Auto Workers strike. And if that continues sustainably, you're going to see impact on the manufacturing sector and so on. So I think these are the few things that will take the dollar lower. And last but not least, currently the Fed's revised forecast talk to around 50 basis points of rate cuts into next year. Having said that, real rates are quite restrictive in the U.S. already. If inflation continues to fall at the rate it has been, as we saw in the PCE, well below, it's moderating more than expectations, which is a good sign. Then, you're going to see, without even interest rates going higher, you're going to see real rates get more and more restrictive. And as a result, the U.S. will have to think about starting to cut rates maybe earlier.